Hi, I am Itaru Matsuyama, CEO of Tsubaki Nakashima, and this is a presentation, English presentation of Tsubaki Nakashima's midterm business plan from 2025 to 2029. So, Tsubaki Nakashima and we had a presentation we had the same presentation in Japanese a few months ago in February this year. It was mainly targeting at the Japanese-speaking investor community, but now we are in the process of enhancing the IR communication and reach to the non-Japanese-speaking investors, the global investors. So, as part of that process, we thought it would be helpful and more investor-friendly to have the English version of the presentation as well. So, we decided to have the same presentation as the Japanese one, which we had in February. So. That's the background of this presentation. And we also put the English presentation on the IR page already in February. So if you want to know more details and read through the slide, if you're interested and if you have time, you can download the presentation file on our IR website. So let's get started. So because some of the audience, I believe, might be new to Tsubaki Nakashima and new to me. So I thought it would be helpful to have a quick introduction of me, not spending too much time, but sharing my background. So I'm Itaru Matsuyama, new CEO of Tsubaki Nakashima, and I was hired by TN last year. I joined the company last May and took over CEO last July. So it's been 12 months plus as a CEO. I was hired by the company and the board as a transformational or turnaround CEO of the company. We will go through all that, the company's financial situation and the new transformation and turnaround plan from here. So that's what happened last year. And my professional background, it's a mixture of three elements. So one is general management in industrial manufacturing. So I spent 8 years in DuPont as a general manager in industrial, automotive, and electronics sector, running the business units and subsidiaries, many times turning around the business unit. So that's kind of core background for me. And at the beginning of my career and before I joined Tsubaki Nakashima, I spent time at BCG as a management consultant. And also I spent 4 years in private equity industry working for KKR as a part of the leadership team in portfolio team, working on the business due diligence and after the acquisition, turning around, transforming the company, driving the value creation of the portfolio company. So that's my background, and I decided to join Tsubaki Nakashima last summer. So about this midterm business plan, since I joined the company last summer, initial several months have been really the setup. So I worked on the assessment and upgrade of the leadership team. So we upgraded some of the CXOs and presidents of the business unit and really enhanced the leadership team. And in parallel with that, new leadership team, including myself, have been working on the diagnosis of the company, the financial performance, operation, the capability, processes, and also the environment, the market, technology trend, the competitive landscape. And based on that, we redefine the company's strategy and also the transformation plan and value creation plan, and packaged it as this 5-year plan or midterm business plan from 2025 to 2029. So behind the scene, we worked on many of the analysis, the data analysis, and also visiting the customers, talking to the customers, and getting a lot of the feedback from the customers, doing a lot of analysis of the competition, understanding the technologies and trend and application and all those analysis and assessment. And based on that, we made this midterm plan. So it's a kind of summary version of it. So it's a very short, but behind that, there is a lot of a thick book of the analysis and execution plan detailed. So that's what it is. So this presentation have a few sections. So first, probably some of the audience might be new to the company. So I wanted to cover the company overview at the beginning. Then as a kind of foundational background of the midterm business plan, I wanted to cover the business environment that we are in. Then, as a third section, the new midterm business plan, 5-year plan. And the fourth section is our strategic intention about cost of capital, capital allocation, and the share price. So my colleague, Yoichi Ueda, our CFO, will cover that section. Starting with the company overview, so Tsubaki Nakashima, we call TN for short, is a global market leader for precision bearing balls. So it's a 90-year-old Japanese precision manufacturing player. Employee is 3,000. Now, the main products we manufacture, really the core products is the precision steel balls for bearing. And there are some portion of the ceramic balls as well. And also, there are some roller products as well. Then at the bottom, as you can see, we have plastic products as well, starting with the plastic balls. And there are some engineered plastic injection molding parts as well for the medical and a kind of high-end precision injection molding parts. And as an end market and application that you can see on the right-hand side, the big one, the main one is automotive, and also several different subsegments of the industrial. So construction machines or manufacturing machines, and some of the clean energy applications such as wind turbine as well. And especially for the plastic, there were medical devices or some consumer products, and also the robotics for like robots used for the e-commerce warehouses. And our market share in steel ball is 30%. So we are the global market leader at this point, and we have 20 plus sites globally. So that's Tsubaki Nakashima as an overview. And the second part is the business environment. So the reason why I wanted to touch on this is since I joined and the new leadership team joined, this is a very important foundation for the plan. And what Tsubaki Nakashima as a company said in the past about the business environment and what we see is very different. So it's a very important kind of premise to share how we see the situation, the environment first, before we talk about the plan. So looking back the past 10 years, some of the investors are very aware of it. Some investors might be new to it. But when we look back the past 10 years financial performance, it had some growth trajectory, then it got stagnant. Then most remarkably, the profitability was lost significantly. So that's what happened in the past 10 years. So the company, Tsubaki Nakashima, acquired the Western competitor NN in 2017. And that was a time of the big jump of the revenue. Since then, the growth has been kind of stagnant. Some shrunk once for the COVID and it came back, but then stagnant a little bit. And as you can see as a dot and line, the profitability, this is an OP ratio, has been significantly declined, has declined significantly. So it started as a kind of high tens, 18, 19%, 10 years ago. Then it went down, especially in the past 5 years, the profitability struggled a lot. So partially the COVID was a trigger, but at the same time, it's partially because of the intensifying market environment, the competition, the cost pressure, the share pressure, and also the company's mismanagement of the situation. The company didn't adjust and address the environmental changes, didn't adjust the profitability and cost position. So because of that, now the profitability is really coming close to the break even in the past 2 years. So to be very transparent, fair, the company has been struggling financially clearly in the past 5 years. So this is a clear turnaround situation. We've been struggling, so we really have to righten the ship and turn around the financial performance. So it's a brutal reality. Let's face the reality. This is what we have to do as a company. And that is, I'm aware, very different from the previous message TN has been communicating in the past 5 years in the investor communities. The company's recognition, the message has been, this is a stable market share is stable. We have a leadership position. Profitability is solid. It's the same, but nope, that's not true. And that good old days is over. This is now very tough environment. it will continue to be tough. So that's the clear recognition that we have. But the point is, yes, it's a tough environment, but we will fight back and we will survive and thrive and succeed in this environment. So that's the history. So this is a review of the previous midterm business plan. So the previous one was 3-year plan from 2021 to 2023. 2024 was a gap year. So we had all the transition, the leadership team. So the previous cycle, 3-year, was 21 to 23. So just revisiting, recapping what happened in the that plan. So it was a mixture, but the revenue was close somehow, but especially the profitability, the cost position, there was a big gap versus the target and plan. So as you can see, revenue is hitting the target. It's largely helped by the FX as well, but it's a mixture. Some of the growth segments actually hit the target. Ceramic, medical, Asia, it grew. Some of them missed the target, but it grew. So revenue technically hit the target, but when we look at the profit and cash flow and dividend, there was a large gaps. And that's really the company worked on the structural restructuring to some extent, such as kind of repositioning, realigning the steel plants in the US or closing the Netherlands plants and moving the roller production to Bosnia. But it wasn't enough. So the profitability recovery didn't happen. The company didn't adjust it to the intensifying competitive situation. So the profitability was lost significantly, and company really struggled operation profit wise, profitability wise. Then the gap year, last year was a transitional year of the leadership change. But as a quick recap, what happened in 2024, it's kind of similar message. So revenue as a number was close. It missed slightly, but it was close. But in reality, again, there is a huge following wind of the FX. So we exclude the FX factor as a volume, it was a shrink. And as many of you are aware, so it's coming from the automotive industry struggle in Europe and even Japan as well. And also industrial side, the manufacturing machines also has been slow. And there was some struggle, the slowdown in the EV as well. So because of that, the volume was down. And especially the OP, the same story, the profitability really struggled. So there were some one-time costs as well, but even excluding it, there was a big gap versus the target. So last year's result was less than 1 billion Japanese yen. So versus the target, that was a big gap. And that's the financial performance on the left-hand side. And on the right-hand side, in parallel, the company has been through the beginning of the big transformation. So the investment of the Japanese private equity fund Advantage Partners and their public share investment team Advantage Advisors happened in late 2023, and they helped to trigger this transformation. So they brought me in as a transformation CEO, and that replaced my predecessor. And I've been working on the assessment and upgrade of the CXO team. The presidents really made the talents at the leadership level stronger. And we optimized the organizational structure, installed some of the global leadership in some of the key functions, such as operations, supply chain, commercial, marketing. So working on these upgrades, in parallel, we worked on this midterm plan development, analysis, diagnosis, and plan development, value creation, driver definition, and setting the target. So that's what happened in 2024. So that was the beginning of the large scale transformation of this company. And as an environment recognition, so this is a tough environment and it's intensifying further. So it's not an easy environment. The good old days of yeah, we are the market leader. It's stable. The share is protected. Profitability is guaranteed. That good old days is over. probably like 10, 15 years ago. Now it's a tough, competitive environment. That's the reality. But there are some growth opportunities when we dissect the market. So very important understanding at the top is um, it's really our customers and customers are struggling as well. So all the automotive OEMs, especially our customers who have been established traditional large Japanese, European, American auto OEMs and industrial OEMs, especially the automotive, those established players are struggling, facing the competition from China, especially EV. Then, as a result, a lot of pressure of the cost reduction and pricing the profitability is being put on to the bearing manufacturers as well, who are our existing customer base, which is Japanese and European big bearing manufacturers. They are also facing the upcoming competitors from low-cost countries, especially China, some India. Then, as a second layer, so this intensifying competition at the ball is happening in the past several years. So especially the competition from China in the past several years, they are clearly getting better, catching up, and there are many, and also their cost position is very competitive, lower labor costs, but also they are productive, and also the utility cost, the steel cost is lower, so they are very competitive in the market. And many of them have a kind of different timeline, different economics of get the share first and make the profit later. So the profit margin level of them is different from us as well. So those are the tough environment as a baseline. But when we look at the market growth, there are a few promising or growing segments. So some example is India, not only the domestic market, but also the export to the established countries are happening, and also aerospace and defense. We under penetrated in this market. It's a high growth market right now. And ceramic bowls, so it's been a historical the growth driver for us. It will continue to be, especially EV and engineered plastic as well. So the company we defined as a medical in the past, now we are repositioning it. It's a high-end, high-quality, precision, clean room-based engineered plastic components. So medical is still the biggest segment, but not only medical as well. Then further, the macro economy or macro environment situation unclarity continues, including tariff situation and European economy, automotive. So we don't have a perfect answer about what will happen. So we have to be carefully monitoring the situation, flexibly adjust and fight back in those changes. So this is the our market recognition, the environment recognition. Again, it's a tough increasingly tougher market, but as we said, given that, we have to admit it and we have to fight back and succeed in this market. So that's the point of our midterm business plan. So, given those environment, what is our new midterm business plan? So, a few setups. So, the new direction of our new 5-year plan. So, premise at the top and direction at the bottom. Very important kind of assumption or the foundational premise at the beginning. It's really difficult to recover the past profit level by doing the same thing. So just keeping the same thing, same approach, same structure, continuing it, we cannot get back to that. So we really have to structurally, drastically change the approach and structure. And as a second point, we have to face the reality. We have to address the cost in a very essential way. So to recover the profitability or even to maintain the market share, we have to really structurally, drastically change the cost position, reduce the cost. That's a very clear reality. And also, we have to work on the cash. We have a heavy debt. Our cash flow management wasn't good in the past. So we really have to focus on the cash generation, really squeeze out the cash to pay back the debt and also keep the dry powder for the future investment. So that's a big, very important premise at the beginning. And based on that, the direction, the three items. Now, we will put the high priority on cash flow generation. So the previous generations of CEO, the message was very clearly only look at the operating profit, not the cash flow. Now we are changing it. So cash is the king is a new mantra in the company. Now, new management team's bonus is directly linked to the free cash flow now. So we put the high priority on the free cash flow, generate the cash, including the working capital management and capex management. So that's a one big change. And the second item is initial 2 years, 2025 and 26, we will position it as a time for kind of seed planting, preparation, the groundworks, really fix things first. So this is kind of hunker down, shrink, and make sure we have the right competitive cost structure and we have the right structure to generate the cash first so that we will reinvest it and restart to grow and deliver the higher profitability in the second half. So that's the kind of baseline direction and intention behind this new 5 year plan. So based on that direction, so this is the full package of the new midterm business plan, the 5 year plan. So at the top, this is the key financial targets. Then the second level is these three strategic directions that I just mentioned in the previous slide. And the third layer is 6 value creation drivers or pillars. And at the bottom is the foundation factors or enablers. So as a key financial targets, a revenue target in 2029 is 87 billion yen. So that is a roughly 15% growth, 3% CAGR. So not to be aggressive, being very realistic, but still try to grow in a realistic, practical way. Then more importantly, in the middle, we will improve the profitability significantly. So last year was a 1% operating profit margin. We will aim for 11%. That means 10 billion Japanese yen in 2029. Then on the right-hand side, a new element we are including is cash generation. So as a cash conversion cycle, as a major KPI, we will target at 175 days. That is 30+% reduction of current to 60 days. It's clearly too much inventory. We should generate more cash. So the three strategic generation: cost, define the business portfolio, redefine the growth segments, and cash flow. So each value creation drivers correspond to those three directions. First three items are cost items. First one is the global manufacturing footprint optimization. Second is the procurement cost reduction. Third is productivity enhancement. So I will cover a little bit more details in the next few slides. Then the fourth and fifth is top line. So fourth is the focus on the newly defined 4 growth pillars: India, aerospace and defense, ceramic, and plastic. The fifth element is the price optimization. And the sixth element on the right-hand side is working capital optimization, reduce inventory, optimize AP/AR. And as an enabler and foundational functions to enable all these changes and transformation and value creation, we will work on the enabling factors. One, so optimize the organization, have a strong function, global function directions and leadership in some of the key functions, manufacturing, supply chain, marketing, and commercial. And also typical managing process. So have the visualization and quantification, make it as a KPI dashboard, so that we can closely monitor the execution and delivery of the value creation in a timely way, so that if something gets stuck, the flag will be raised, we can step in and fix it and recover it. And also the very important part is the employee is the core of everything. So we will aggressively working on enhancing the employee engagement and commitment and motivation. So we just launched a new purpose, vision, mission, value. That's one example, but working on the training, working on really making the culture change, making it more performance oriented, result oriented. And also SIOP, so inventory management system, and also enhancing the IT system to enable all these. So that's the full package of the value creation plan, transformation plan. As a financial numbers, a bit of a breakdown here. So as you can see on the top left, the revenue. So first 2 years we don't grow. So being very realistic. But we will prepare for the future growth. We are desperately working on the sales pipelines, working on the new business development, the partnership with some of the customers and suppliers, so that we can recover and make sure we can grow in the later half of the 5 years. So it's a 3% CAGR, not too aggressive, but make sure we can clearly, surely capture this growth. And more importantly, at the bottom left, OP ratio, we again, the first 2 years, we don't see a drastic improvement still because we have to work on the actions, executions. It will take some time. There is some time lag. So we can work on the cost structure in the first 2 years so that we can generate the higher profitability in the later half and recover the double digit 10 to 11% operating profitability in 28 and 29. And as you can see on the top right, the cash conversion cycle aggressively reducing it by 30% plus. And as a result, ROE significantly improved. So this is the financial target we will aim for, and we are committed to deliver. Then this is the breakdown of the value creation impact and driver. So this is a kind of simulation to show how it is structured. So as you can see on the top level, this is the sales in billion yen. In the middle, this is operating profit in billion yen. At the bottom, this is OP ratio. And left-hand side is the last year's actual result. Then right-hand side is the 2029, 5 year later target. In the middle is 29 baseline, meaning as is, meaning if we don't do anything, if we continue to do the same thing, if we keep the same trajectory, this is what will happen in 5 years. So as you can see on the left-hand side, some elements such as the market situation, competitive changes, the environment will continue to be tougher. Then there is an inflation factor, so the cost will be up. So as you can see, the revenue of 2029 in the middle, without doing anything, the revenue wouldn't grow. It will shrink a little bit. Then, especially the profitability, we will have a lot of cost pressure and price pressure. Because of that, in 2029, we will be in red. We will start to lose money in 5 years without doing anything. So, as I said, we will, as a leadership team, we will fight back and survive and thrive. So, cost reduction drivers, as I mentioned, footprint, procurement, productivity, each has a few billion yen impact. And on the right-hand side, there is a top line item. So the growth in the key growth drive segments and the price optimization, that will have some impact as well. 2/3 is actually the cost reduction. So including both, we will have significant profitability improvement. As a result, we will aim for and deliver the 10 billion Japanese yen OP in 2029. That is calculated as an 11% OP percentage. So this is the kind of summary of the midterm business plan. Let me touch on some of the breakdown, some of the nuance and specificity about each drivers on the key items. So the cost items, so there are three major items, and each of them coincides with the reason why TN has struggled in the past. It's kind of deeper root cause of the financial struggle in the past. So first item is the global manufacturing footprint optimization. So company TN grew by global expansion, but mainly by acquisition of the independent companies, the plants one by one, including the big one NN. So it kept expanding, but we haven't done step back and see the entire picture and really define what's the real optimal supply chain network, what's the right footprint, and what's the right number of the plants. We have too many plants at this point. So we will merge, integrate, and focus and enable the global sourcing as well. So moving some of the production to some other lower cost countries to supply some of the higher cost countries, including Americas and Europe. America is getting a little bit tricky because of tariff, but general direction, that's what we will try because customer wants it. So by that, we will reduce the fixed cost level as a total company and increase the utilization of the plants. So that's the first driver. And the second cost driver is the cost reduction by procurement. So it's kind of similar story. So the company's past procurement managers, they were in each plant, and their main role was make sure the material is ready. So we haven't done as a company globally coordinated with the clear intention to aggressively integrate and optimize the supplier network, aggressively negotiate and reduce the cost. So we will do it. So we get the new chief supply chain officer who is an expert of that, the global integration and optimization of the supplier network and cost reduction negotiation for both direct material and indirect materials. Number three is productivity. So the way of the production, the process and the machines has been traditional. So there are a lot of opportunities to optimize the process by simplification, streamlining, automation, standardization, and digitalization, both as the actual process or manufacturing engineering, just basic stuff such as learning from the best practice plants. We haven't done it enough. So we will do it at the global scale. And by doing that, reduce the cost position, improve the throughput and yield, reduce the waste and defect. So through those three drivers, we will aggressively work on the cost reduction. Then the next page is about the top line. So the four growth pillars, new growth segments. First one is India, clear growth market. So, and it's a unique situation where there was a kind of dominant local competitor in India. Now, we started manufacturing 10 plus years ago, and we launched a second plant in India. Customers have a clear message of TN, please continue to increase the capacity. We want a second supplier and we want to buy from you. So we will continue to invest and enhance the revenue in India for the local market, for both existing kind of established berry manufacturers from Japan and Europe, and also local customer, local market as well. Plus the export for the higher cost countries, Americas or Europe. And the second element is aerospace and defense. So TN has underpenetrated this market. So now this is a clear focus area for growth. So this is another unique area where it's a high growth. And again, the bold supplier situation has been a little bit skewed to the existing supplier. So we are the new player, but we have a solid position, especially in Americas with the clean room setup and the aerospace and defense industry certificate. So now we are aggressively working on partnership with the customers, enhance the new application development in aerospace and defense. It's a unique business. It takes time to penetrate, but once you are in, and it's a higher profitability. And the third segment is ceramic bowl. So this is historically the focus area as well. So we will continue to invest, but the growth speed compared to the past projection, it's getting a little bit modest. So the competition is getting tougher, especially the China EV market. We see a clear contenders from China as a ceramic bowl manufacturer. So we are working on the low cost material and low cost products specifically for designed for EV market. But we will continue to invest and grow in ceramic bowl as well. And the fourth area is engineered plastic. So not only medical, but some of the consumer and also the robotic as well. Leveraging our precision clean room injection molding parts and precision plastic bowl manufacturing, we will continue to grow. And as a fifth element, the price optimization. So the company, even though it's been the market leader, we have had a weak commercial capabilities. So value pricing didn't happen in the past. So I'm not saying we can raise the price for all the segments. It really depends on the segments and applications. So big chunk of the segment in automotive, for example, some of the commodity segments is facing the price competition, so it would be difficult. But for industrial, some of the differentiated kind of unique side balls or unique spec balls or unique material balls, there are a little bit more engineered or customized balls where we have a unique positioning and value proposition. So based on that, let's have a correct pricing, value price it. And as a sixth value creation driver, cash conversion cycle, a bit of a breakdown. So the most important item is the inventory. So we will reduce the cash conversion cycle from 260 days to 175 days. By that, we will generate 17 billion Japanese yen. So this is sounds to be an aggressive reduction, but historically, the company has clearly under invested in or under um, leveraged or we didn't do enough for the inventory reduction or cash generation. So I heard some of the stories that a few generations ago, the company management's direction was the more the inventory you have, the better. Don't look at the cash flow, only look at the operating profit. So that's a kind of some Japanese traditional companies do that kind of mentality. We are changing it drastically. Now, cash really matters. Cash is the king. Cash flow is the most important KPI. So we will generate the cash by really optimizing the inventory level. So some of the elements. So make sure it's typical Toyota production system or the goal, the concept. Make sure we only buy and manufacture the amount that we can sell. Let's define the minimum inventory level, minimum order amount, depending on the customer, depending on what product, negotiate with the customers, optimize the contracts, define the minimum order quantity, and reduce it. Let's have the correct, accurate demand forecast. Based on that, let's have a correct, accurate production planning and inventory planning. So continue to chip away 30% reduction. The same for account receivable as well. We haven't pushed enough. We haven't negotiated with the customers enough. So let's revisit the contracts, figure out the right structure, and negotiate with the customers, work with the customers. And account payable is the same. So as a total, reduce the cash conversion cycle from 260 to 175, 17 billion Japanese yen. So last element about this midterm plan is the execution system. So we want to guarantee, we want to make sure we will execute and deliver the impact of value creation in a timely manner. To do that, we need the execution system. So two major elements. One, I firmly believe the leadership is the difference maker. That's the very important factor. So make sure we have a strong, capable, committed leadership team. So that's why I've been worked on the upgrade of the leadership talents. N-1 level is done. So I'm bringing in some of the stronger leaders from outside the company, mixing with some of the strong long-timer executives in the organization. And also make sure we have a global collaboration, the cross-functional communication and collaboration. It has been another weak point of this company. It was very siloed and compartmentalized. The BU didn't talk to each other. Function didn't talk to each other. There was not enough kind of cross BU, cross-functional, typical matrix function. So let's make sure we can organically function and collaborate as a one team. And the second piece is a strict program governance system. So we hired and installed a transformation director position that is the quarterback of the transformation. So he will be a kind of custodian of the execution. So we hired Shogo Komuro as a transformation director. He was a former McKinsey engagement manager who has been doing the same thing for his clients in McKinsey. And we clarify and detail the execution plan and the target based on the timeline. And we monitor the progress of the execution based on the KPI. If something gets stuck, the flag will be raised. We will step in and fix it, and we will recover. And free cash flow is now the big part of our bonus. So that everyone can understand that's a very important metric. So the last section is our strategic intention about cost of capital, capital allocation, and share price. So our colleague, CFO Yoichi Ueda, will cover this section. Yoichi, please go ahead.
Hi, I'm Yoichi Ueda, CFO of Tsubaki Nakashima. I will cover capital allocation strategy and our initiative to enhance our shareholder value. On capital allocation, as you see in the left slide, we plan to generate 50 billion Japanese yen in next 5 years. This is realized with our operating cash flow, helped by significant improvement in working capital. And of that 50 billion cash proceed, our number one priority is to use that, more than 50% of that, to reduce our debt. So as you see, the 30 billion plus cash flow will be used to repay our debt. This is to improve our financial health and stability of this company. As you know, our debt position is quite high with the past legacy of the MBO and then acquisition. And obviously, that's our number one priority. And number two priority is about our capital investment. This is a source for growth. So we manage in the next 5 years that 10 billion capital expenditure for basically renewal and capacity investment. This is for the kind of regular investment. While we are also securing the strategic investment, the same amount, like 10 billion strategic investment to enable our transformation and portfolio change and cost reduction. So that's our number two priority. Number three priority is about shareholder return. So as we set the phasing, we will have a first 2 years or so for the seed planting period. After the seed planting period ends, we will restart dividend, shareholder return, and also we plan to target the dividend payout ratio to around 30%. This slide shows the past 5 years trend of PBR and ROE. As obviously seen, PBR is way below 1.0 for the last year, end of 2024. And ROE trend is also just marginally positive in last year. This is clearly not what we want and what we want. And we recognize our should be cost to capital is 8 to 10% range. And we believe that we can achieve this level in the year 4 and year 5 of our midterm plan. Next slide, please. So in order to reach this level of ROE and even accelerate this achievement timing, the first thing we want to try is basically to ensure the strong execution of value creations, covering the top line growth, bottom line with cost structure change, and cash flow focus. Concurrently, we enhance the communication and engagement with investors. And this session is obviously part of this initiative. And we improve the governance with strong financial discipline. This is to really reduce the cost of capital, and eventually that will be leading to the enhancement of the shareholder value. For the ESG initiatives, I'll pass it to Itaru to ESG and for the wrap up.
So this is the last page of the presentation. So ESG initiatives. So 3 sections of each of ESG. So environment on the left-hand side, we will continue to work on reducing the carbon footprint, and we will increase the renewable energy share, and we will maintain a CDP rating of B or higher. Then as a social, so this is the area that TN has been relatively weaker. So we will enhance this area aggressively. So working on enhancing the employee motivation and engagement, making the culture change, making it more performance oriented, result oriented, dynamic, and growth oriented. And also, we will continue to invest and strengthen the employee talents by development, training. And the last item on the right-hand side, the governance, we will also work on it to enhance the governance. So we are working on streamlining and optimizing the audit committee and internal audit. So we upgraded and strengthened the talent of the audit team. Now we are working on optimizing the process and capability and enhancing some of the system, including whistleblowing system globally. And also, the compliance is the focus area as well. So we are working on enhancing the compliance culture, introducing the compliance training for all the employees globally, and working on the manager training for the open communication, making sure employees can speak up, those kind of items. And we are also working on enhancing the risk management committee, streamlining the process, optimizing the system and assignment. So those are the initiatives that we are working on in the ESG part. So that's all for our new midterm business plan presentation. Thank you for your time and thank you for your attention. As I mentioned, now the presentation deck is on the IR page. So if you are interested in, if you have time, please feel free to download it and please read through some of the details. Again, thank you very much for your time.